Hey everyone, welcome back to Corporate Decoder, the place where we try to make sense of the alphabet soup of corporate finance filings. You know, the ones with enough twists and turns to give you whiplash today. We are diving deep into Ready Capital Corporation's latest quarterly report. And let me tell you, there are some interesting shifts happening under the surface, some good, some well, others we need to decode. Carefully. Let's get straight to the numbers looking at their balance sheet for the 30th of September 2025. We see their total assets standing at $8.3 billion, a noticeable drop from $10.1 billion just a few months prior. A big chunk of that decrease comes from assets of consolidated variable interest entities, or VIES. These are basically entities that they control. Even if they don't own them 100%, their value plunged by a massive $3 billion. This happened mainly because some securitization structures they were involved with collapsed, and others paid down a lot. This really points to them cleaning up their balance sheet and potentially shift. In focus. On the flip side, their real estate owned jumped up significantly from $193 million to over $632 million. This could mean they took on more properties, perhaps through foreclosures, or as part of their investment strategy, which is a big jump in their physical asset holdings. Now, liabilities, wow, these also came down significantly. Their total liabilities dropped by $1.7 billion, reaching $6.4 billion. A huge part of that is the securitized debt obligations of consolidated VIES, which fell by $2.3 billion. This aligns with the decrease in their VIE assets, suggesting they are closing out or paying down those structures. However, secured borrowings went up by $843 million to $2.8 billion. This is a really important trade-off. They are paying down some debt from those VIES, but taking on more secured borrowing, which means more loans directly tied to specific assets, like their actual real estate loans. This is a common move for companies looking to restructure their funding. Looking at stockholders' equity, it reduced slightly by about $60 million to $1.9 billion. This is largely due to dividend payments and stock repurchases, which is pretty normal, but also shares issued because of an acquisition. This tells us they're rewarding shareholders, but also using stock as currency for growth. Now let's look at how they make money. The report details their revenue recognition policies, stressing that most of their income, like interest income and fees, are recognized when earned and it is believed to be collectible. This is standard business practice, but highlights their focus on cash-generating activities. When we dig into their segments, the LMM commercial real estate segment showed a significant drop in interest income by $87 million. The report attributes this mainly to more non-accrual loans, meaning loans that are not paying as expected, fewer loan balances, and lower interest rates. This segment is clearly facing headwinds. The LMM segment reported a net interest income loss before loan loss provisions of $700 million for Q3 2025. It's a much smaller loan book now, and it's struggling to generate positive net interest income before accounting for potential loan defaults. The small business lending segment, however, shows a different picture. Despite a slight dip in interest income, interest expense also fell, leading to a better net interest income picture before loan loss provisions compared to last year. The recovery of loan losses in this segment for 2025 is a positive sign, suggesting they are improving their collection or management of problem loans. A really interesting number is the valuation recovery for loans held for sale, jumping to $178 million for Q3 2025. This suggests that the market value of these loans they intend to sell has improved significantly, or perhaps they have set aside less money for potential losses, which can be a good sign but also worth watching closely. The report also highlights significant realized losses on financial instruments and real estate owned, particularly in the LM segment. These losses are substantial and clearly impact their overall profitability for the quarter. Their fair value measurement section details how they value their assets and liabilities, particularly level 3 assets, which are harder to value because they rely on unobservable inputs. These include things like investments in unconsolidated joint ventures and contingent consideration from acquisitions like the UDF-IV deal, which had contingent value rights that added $17.9 million in value. It shows how much of their valuation relies on estimations and market assumptions, which can be volatile. Servicing rights represent the value of their fee-earning work in managing loans for others. While these are declining slightly in carrying value, it shows a steady stream of income potential. Their SBA servicing rights, for instance, add up to over $40 million in carrying value, showing a consistent book of business. A major story here is the divestiture of their residential mortgage banking segment. This means they are selling off that entire part of their business. They classified it as discontinued operations, and the numbers for it are no longer part of their ongoing business. The sale of these assets is a strategic move to focus on their core LMM, and small business lending. These are no longer assets or liabilities held for sale, as of the 30th of September 2025, indicating the sale is complete. Looking at their financing, secured borrowings total $5.4 billion, which is a significant amount, but mostly tied up in repurchase agreements. These are short-term agreements often using loans as collateral. To get cash, these structures are common but can be volatile, especially in tight credit markets. They also have senior secured notes net totaling over $721 million, which is a big jump from last year mostly. Due to new debt issuances, this points to them raising more capital for their operations. Corporate debt net shows a decrease down about 25%. This suggests they are paying down some of their unsecured debt, which could be a positive sign for their overall financial flexibility. Guaranteed loan financing also shows a decrease down about 18%. This likely reflects them managing their funding sources and potentially selling off or paying down certain types of loans that don't perfectly fit their strategy. This is usually a good sign they are optimizing their capital structure. Their securitized debt obligations are substantial, with over $1.2 billion outstanding. These are complex financial structures used to package and sell loans. This also saw a big drop from last year, mirroring the decrease in consolidated via assets. Contingent consideration has jumped significantly from less than $1 million to over $18 million. This is often tied to acquisitions like the UDF-IV merger, meaning they owe more money or stock if certain performance targets are met. This is a key indicator of recent growth through acquisition and the potential future payouts to sellers. Let's go back to the LMN commercial real estate segment and look at the balance sheet side. Assets here are growing substantially, while loans net, a core asset, are up significantly. Real estate owned has also seen a massive increase, nearly tripling. This hints at them potentially taking on more properties, maybe through foreclosure or due to loan workouts, which can be a double-edged sword. More asset, but also more management responsibility and risk. The small business lending segment shows a more stable picture. Assets here are relatively steady, indicating continued strength, or at least stability, in this part of their business. Overall, total assets are down by nearly $1.8 billion, which is a big number. But as we saw, it is largely driven by shedding complex VI structures and paying down securitized debt. This looks like a strategic decision to streamline their business and focus on core lending. Correspondingly, total liabilities are down by $1.7 billion. Again, reflecting that cleanup of VI debt, but importantly, secured borrowings have significantly increased. This is a classic sign of restructuring, where they are replacing one type of funding with another, potentially more manageable one. Stockholders' equity is down slightly, mostly due to dividend payouts and share buybacks, but non-controlling interests are up slightly. This suggests that entities they don't wholly own still hold a significant stake, showing they are not entirely independent in some of their operations. Now for the bottom line, net income tells a mixed story. For the 9 months ending September 2025, they reported an income of $11.5 million, a big turnaround from a loss of $115 million in the same period. Last year, this is really driven by a huge valuation recovery on loans, and that bargain purchase gain from the UDF-IV merger, which artificially boosted their income. And this is a big, but let's look at distributable earnings before realized losses, which is a better measure of operational performance. This number shows a loss of 14 cents per S-share for Q3 2025, compared to a positive 25 cents per share last year. This stark contrast highlights that the reported net income is heavily influenced by one-time events, like acquisition gains and write-downs, not necessarily by ongoing business strength. The operating income is actually worse. And if we look at distributable earnings attributable to common stockholders, they are down significantly in Q3 2025, showing a loss of 94 cents per share compared to a loss of 28 cents last year. This deepens the concern that the core business is facing challenges despite the headline net income figures. Their dividend yield remains high, around 13%. This is a REIT characteristic, meaning they have to pay out most of their income as dividends to shareholders. But when you look at the distributable earnings, it begs the question, can they actually sustain these dividends without eroding their capital base? It's a classic REIT dilemma, paying out cash flow that might be better reinvested. The LM commercial real estate segment reported a big non-interest loss of $134 million year to date. This is largely due to realized losses on financial instruments and real estate, and a decrease in that valuation recovery we talked about earlier. This segment is clearly a drag on performance. The small business lending segment, however, is doing much better, showing a non-interest income of $93 million year to date, driven by loan origination income and realized gains. This segment is performing solidly and seems to be a bright spot. The corporate side, which includes things like management fees and gains from acquisitions, showed a big jump in income year to date, mostly because of that bargain purchase gain from the UDFIV merger. Without that, the corporate segment would likely be showing a loss as well. Looking at the total net income before taxes, the company reported a loss of $38 million for the 9 months of 2025, down from a much larger loss last year, but still a loss. So while the headline net income numbers look good, the underlying operational performance measured by distributable earnings paints a less rosy picture. In summary, Ready Capital Corporation is going through a significant transformation. They are shedding parts of their business like residential mortgage banking and restructuring their funding by taking on more secured debt while paying down complex buy-related debt. The small business lending segment appears to be a strong performer and a key driver of their current success. However, the risks cannot be ignored. The report mentions risks associated with achieving synergies from recent acquisitions like UDFIV and Funding Circle. This means promising cost savings and efficiencies may not materialize. And of course, the constant threat of interest rate fluctuations remains a major concern for a financial company. Like this, rising rates can squeeze margins and increase loan defaults. In conclusion, Ready Capital is making bold moves to simplify its structure and focus on its core lending strength. The UDFIV merger definitely provided a short-term boost to net income, but the operational performance measured by distributable earnings excluding one-time items shows significant challenges, especially in the LM commercial real estate segment. The high dividend yield is attractive, but investors should be aware of the underlying profitability before those won. Time accounting adjustments and be mindful of their increasing secured borrowing and the potential for this dividend to be unsustainable. If operational performance doesn't improve, what is your take on Ready Capital's strategy? And these financial results, do you think they are making the right moves to navigate the current economic climate? Let me know your thoughts in the comments below. If you found this breakdown valuable, please hit that like button. It really helps us out, and subscribe for more corporate deep dives. Like this, we have a growing community over on Discord too, so come join the conversation. Link is in the description below. Thanks for watching. See you next time.